Welcome to today's lecture on key indicators and oscillators, essential tools in technical analysis for market forecasting. These indicators help traders recognize trends, detect reversals, and understand overbought or oversold market conditions. Our focus will be on the fundamental ones you need to know, blending practical insights and examples to improve your trading decisions. Let's dive in. Indicators and oscillators are critical tools in technical analysis. Indicators focus on identifying trends and signals, divided into trend-following indicators, which confirm trends, and momentum indicators, which gauge strength. Oscillators, on the other hand, work within a range, often from 0 to 100, to highlight overbought or oversold conditions. The key difference? Indicators confirm trends while oscillators signal potential turning points. Moving averages are essential trend-following indicators. The simple moving average, SMA, calculates the average price over a period, while the exponential moving average, EMA, reacts faster to recent changes. A golden cross occurs when a short-term MA crosses above a long-term MA, signaling a buy. A death cross signals the opposite. For example, when stock XYZ's 50-day SMA crosses above the 200-day SMA, it indicates a potential upward trend. Here we see two key examples of moving average crossovers. On the left, the golden cross occurs as the 50-day SMA crosses above the 200-day SMA, signaling an upward trend. On the right, we see the death cross, where the 50-day SMA crosses below the 200-day SMA, indicating a potential downtrend. These crossovers are widely used by traders for identifying entry and exit points. Bollinger Bands help traders identify overbought or oversold conditions by using a moving average with bands placed 2 standard deviations above and below it. When the price touches the upper band, it may indicate overbought conditions and a potential reversal. Conversely, touching the lower band suggests oversold conditions and a potential upward bounce. This slide demonstrates the use of Bollinger Bands in trading. On the left, the stock touches the upper band and then falls, signaling a potential sell. On the right, a similar scenario occurs. When prices approach these bands, traders watch for reversals. The lower band often signals buying opportunities, while the upper band signals potential selling. However, it's important to confirm these signals using other indicators, such as RSI or MACD, to reduce the risk of false signals. Remember, trading decisions should primarily be based on fundamental news and analysis, while Bollinger Bands and other technical indicators are tools to help optimize entry and exit points. When using Bollinger Bands, selecting the right length is key. For short-term traders, 14 to 20 periods offer high sensitivity but frequent touches, while swing traders prefer 30 to 50 periods for smoother bands and fewer false signals. Long-term investors often use 50 or more periods to capture macro trends. If 20 periods feel too short, start with 30 or 50 and a 2.5 standard deviation. Always backtest and adjust these settings based on your strategy. The Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements, ranging from 0 to 100. When RSI is above 70, the asset is considered overbought, signaling a potential sell. Below 30, it's oversold, suggesting a possible buying opportunity. For example, if stock ABC's RSI reaches 75, it may indicate overbought conditions and an impending correction. Combining RSI with other indicators, like moving averages, can improve accuracy. The default setting for RSI is 14 periods, as recommended by J. Wells Wilder, its creator. However, this may not always be optimal. Traders should adjust it based on asset type and trading style. In the example shown, notice how the RSI rises above 70 during overbought conditions, signaling potential sell points, and dips below 30 in oversold areas, offering potential buy signals. Proper adjustments and confirmations can refine trade entries and exits. Choosing the right RSI length depends on your trading strategy. 7 to 10 periods work well for intraday traders, offering high sensitivity but more noise. The default 14 periods provide a balanced approach suitable for most markets. For smoother, more reliable signals in swing or long-term trading, 20 to 30 periods are ideal. If 14 periods feel noisy, try increasing it or combine shorter periods with tools like Bollinger Bands for stronger signals. The Moving Average Convergence Divergence, MACD, measures the difference between the 12-day and 26-day EMAs, with a 9-day EMA as the signal line. A buy signal occurs when the MACD line crosses above the signal line, while a sell signal occurs when it crosses below. This indicator helps traders identify trend reversals and momentum shifts. This example illustrates how MACD signals potential trade entries. On the left side, the arrow points to a potential long entry, where the MACD line crosses above the signal line, suggesting upward momentum. On the right side, the arrow highlights a potential short signal, where the MACD crosses below the signal line, indicating a possible downtrend. These signals help traders align their trades with market momentum. Choosing the right MACD settings depends on your trading style. Shorter settings, 6, 13, 5, work best for scalping or intraday trading, but can be noisy due to sensitivity. The default, 12, 26, 9, is a balanced option, suitable for general markets and a range of assets. For swing or long-term trading, longer settings, 19, 39, 9, help filter out noise and focus on major trend changes. As a suggestion, short-term traders can start with 6, 13, 5, while long-term traders should try 19, 39, 9, and backtest the results for accuracy. The stochastic oscillator compares a security's closing price to its price range over a specified period. It consists of two lines, the %K line, which is the main indicator, and the %D line, which is the moving average of %K. The formula calculates how close the current price is to the period's high or low. When %K crosses above 80, the asset is considered overbought, signaling a potential sell. When %K crosses below 20, it's oversold, signaling a potential buy opportunity. This example uses the stochastic oscillator with settings 2155. On the chart, when %K crosses below 20, as highlighted, it signals a potential buying opportunity due to oversold conditions. Conversely, when %K crosses above 80, it indicates a potential selling opportunity due to overbought conditions. These signals can be more effective when confirmed with other indicators or fundamental news. Choosing the right stochastic oscillator settings depends on your trading approach. Short-term traders can use 533 or similar, providing high sensitivity but prone to noise, ideal for scalping. The default, 1433, offers a balanced approach, suitable for most markets and trend-following strategies. For swing or long-term traders, settings like 2155 help smooth out noise and generate more reliable signals. Adjust these settings and backtest to find what works best for your strategy. The Commodity Channel Index, CCI, measures the deviation of a security's price from its average price over a specified period. Unlike RSI, CCI is unbounded, meaning it can move beyond typical 0 to 100 ranges. When CCI above 100, it signals potential overbought conditions, indicating a possible sell opportunity. When CCI below -100, it suggests potential oversold conditions, signaling a possible buy opportunity. Traders often use CCI alongside other indicators for confirmation. This example uses the Commodity Channel Index, CCI, with a period of 40. When the CCI rises above 100 and then falls, as shown by the arrow on the chart, it signals a potential reversal or sell opportunity due to overbought conditions. On the other hand, when the CCI drops below -100 and then rises, it suggests a potential reversal or buying opportunity due to oversold conditions. Monitoring these levels can help traders catch market turning points effectively. Choosing the right period setting for the CCI depends on your trading strategy. Shorter periods, 10-14, are ideal for scalping or intraday trading, offering higher sensitivity but more noise. The default 20 periods strike a balance and work well for identifying medium-term trends and reversals. For swing or long-term trading, longer periods like 30-50 reduce noise and provide more reliable signals. If you're seeing too many false signals, try increasing the period length or adjusting thresholds to account for market volatility. Combining multiple indicators and oscillators enhances decision-making by providing stronger signals. For example, RSI can identify overbought or oversold conditions, while MACD confirms trend direction. Similarly, pairing Bollinger Bands with the stochastic oscillator helps detect breakouts or reversals. In the example, stock ABC shows a breakout indicated by Bollinger Bands, and RSI confirms it's overbought, suggesting a potential sell signal. Combining these tools reduces the likelihood of false signals. This chart shows how combining indicators can generate strong buy and sell signals. On the left red line, the buy signal occurs when the price touches the lower Bollinger Band, RSI approaches the oversold level, 30, and the MACD line crosses above the signal line, with the histogram turning green. On the right red line, the sell signal forms when the price touches the upper Bollinger Band, RSI reaches the overbought level, 70, and the MACD line crosses below the signal line, with the histogram turning red. Remember, these signals are more reliable when combined with fundamental news like earnings or economic events, which we will discuss later. While indicators and oscillators are valuable, they do have limitations. Lagging indicators like moving averages and MACD follow price action, often providing delayed signals. False signals are common in highly volatile markets, where oscillators may incorrectly indicate overbought or oversold conditions. Additionally, market conditions matter. Trend-following indicators like moving averages perform better in trending markets, while oscillators like RSI are more effective in ranging markets. Understanding these limitations helps reduce trading risks. In summary, technical indicators and oscillators are essential tools for traders, providing insights into market trends, reversals, and momentum. By combining multiple indicators and understanding their limitations, you can significantly improve the accuracy of your trading decisions. However, remember to backtest and validate signals before applying them in real trades to minimize risks and false signals. With practice, these tools can help you build a more confident and strategic approach to trading.